Good afternoon from the Shreveport office of Eagle Financial Management Services, a wealth care company, for the February 10th, 2023 edition of the Jack and Bill Show.
Oh, terrible.
Hope you're having a wonderful Friday afternoon before, at least here in Shreveport, there is rain threatening as we speak. But
I'm going to get you people.
But that's not going to spoil the Super Bowl festivities for Super Bowl number 57.
Don't get ahead of yourself. Not time for
Okay.
sports.
Okay, well, I just wanted to show off my Eagles hat. I have been to Eagles games before in Philadelphia, back when they played in the Vet. And they have the meanest fans, I can assure you, of anywhere in the United States that I have ever encountered. So there are some interesting firsts in this game, Bill. I think the Chiefs are slightly favored. I'm sorry, I think the Eagles are slightly favored now. It's been back and forth, but this is the first time ever. Do you know what any of the firsts are?
Well,
I'll give you a chance.
It's the Bengals. I said last time the Bengals would win it all.
They're not in it.
They deserve to be in it. They should be in it.
Okay, we've got two black quarterbacks playing against each other for the first time ever. And I'm sorry, I'm going to turn my phone off. That was my wife calling me. So we've got Patrick Mahomes. He's arguably the best quarterback in the NFL, lining up against Jalen Hurts. Jalen Hurts being a profound success story this year, William. Recall that he was one of Nick Saban's stalwarts that won a Super Bowl under Alabama to return the following year and find out he had lost the starting position. So he transferred to Oklahoma, winds up playing Alabama in the college football playoffs, kind of got hammered, makes it into the NFL, and the guy that replaced him at Alabama, Tua, has been, I don't know what his playing future is. He's been hammered. He's been hammered with multiple concussions. He could probably get hundreds of millions against the NFL if he wanted to for the mishandling of some of his concussions on the field, his continuation of play. Anyway, Hurts has retaken the spotlight in that matchup, Tua versus Hurts. And anyway, then the other thing that's profoundly interesting is Kelsey, the tight end for the Chiefs, will be playing against his brother, who I think he's the offensive snap center for the Eagles. But anyway, I'm picking the Eagles by a touchdown. And other key matchups in the game, it's going to be who can run the ball, and then there could be an NFL all-time record set with sacks. There's only been two NFL teams, both of them from Chicago back in the Mike Ditka days.
The Bears
that had more sacks in 1 year of football than Philadelphia has had. 78 sacks so far this year, 70 in the regular season and 8 in the postseason, and they need a handful more to set the NFL record. So they have a very strong and deep defensive line. They rotate them in and out, and if they can, the big question is Mahomes' ankle 100%, and can he evade Philly's defensive line that wants to crush him? And I think the other one is, defenses generally win these types of games, but I actually think Philadelphia is going to be able to run the ball, and they have a key tailback who's a graduate of Louisiana Tech University. There happens to be 2 Louisiana Tech players playing in the game, players of local interest. LSU only has 1, and he won't be taking the field because he's on injured reserve, the tailback from Baton Rouge, LSU, that was replaced with Kansas City when he hurt his knee. So Hilaire, Clyde's Edward Hilaire. So I'm sure that our wealth care employer is going to be rooting for the Eagles. I don't know if any. There's a gentleman in my neighborhood who's at the Waste Management Open these 3 days for the golf match, and then heading over to the Super Bowl to watch that. But what do we have to share today?
Thank you for tuning in to ESPN 4, 5,
Eagle
6.
Sports Network.
Yes, I'm ready.
I'm just kind of struggling right now. You may be wondering why I have this monstrosity here.
They can't see it though. Lift it up for the people.
This is what Wesley made me eat for lunch today from a local taqueria, and I'm hurting.
Well, it looks like it's still full.
That's his.
That's what's left of mine.
Mine's gone. So anyway, too much information. Really not a lot to report since our last show. I mean, the markets continue this healing process. We saw the stock and bond markets begin a recovery rally in October, and that continues year to date. I think we can say it's been a risk-on rally, judging by, for example, high risk or high beta stocks performance against low beta or low volatility stocks. You look at the performance of cyclicals against defensive stocks. You look at yield spreads between high yield bonds and investment grade bonds. I mean, all these things are pointing to a risk on. We've seen the markets a little weaker this week, but I wouldn't read too much into it.
Well, and Bill, that's really because last Friday we got the January employment numbers that came out, and this was really, earth-shattering. 517,000 new jobs created for the month of January, and the unemployment rate declined to the lowest it's been in, I think, 60-some years, all the way down to 3.4%. And that is inflationary, my friend, because 2/3 of all inflation historically coming from unit labor cost increases. And when you're doing 500,000 jobs a month, there's going to wind up ultimately being a shortage of labor. So whatever business that you're in, if you want to hire somebody, you're probably going to have to bid up the price, to get someone to leave another job to come work for you. And so that's why we're down a little bit this week, is because everyone's saying this might be inflationary. This jobs number means that we were only going to get one more tightening likely. Now the futures markets are indicating we've got 2 more to go. That's all going to be data dependent. Mm-hmm. And the Fed's been good with giving us forward guidance, trying to sneak some of that information out there. So, but I happen to think that, and then there's a lag in there, William. We've got a lot of technology layoffs being announced. Disney announced 7,000 jobs being cut yesterday. So the next employment report is probably going to reflect 100, maybe 110,000 layoffs in there. So, and then what's it going to be after that, the next month after that, and after that, but, so the S&P 500 at this juncture is up 6.4% year to date, down a smidgen today, and bond yields are up today. Oil is up today, right at the $80 level again. I think that you really have to watch oil. Do you agree, Bill? I think that oil is key to a lot of things in the commodity space.
I'm watching oil.
Black gold. Black gold. Texas tea, my friend. So commodities, after having a really strong year last year, are down. The Dow Jones Commodity Index is down 2.83% this year to date. The big loser, which is very important to our community here, is natural gas prices having declined from highs of about 9, sometime last year, all the way down to $2.43. I don't think they're going to stay there, either. But what do you have to add to any of that, William?
Got nothing.
Nothing. Come on, man. Well,
Sorry.
I would like to say this.
Wesley ruined me.
We had a client review with a large client yesterday, and a couple of things that came out that I wanted to point out, where I think this is very important for our viewers. So, and I just did a client review at lunch today, and fortunately I held back on my Chinese buffet. I did not
Really?
buffet my body all that badly.
That's not like you.
So, yes, but we discussed this. The one of the really good opportunities, and we'd like to just throw this out there, kind of. This has come out this week, with our clients. The banks are. Is this intermediation or disintermediation? But cash coming from the banks, I get those mixed up.
I'd call that disintermediation. So
Okay.
what's happening is that if you look at the bank as an intermediary, people are going around the banks,
Okay.
or pulling money out of banks and putting them into money market funds.
Thank you for that clarification. So I sent. We have a Schwab fund that has $1 million minimum that is yielding 4.72% right now, just to type your money in a money market. And most of the banks are paying less than 1%. Like probably the national average is probably 0.5%.
But you don't have to have $1 million.
And if you don't have $1 million, you still get like 4.6%. And that's with $1,000.
Very good.
So we actually I bought a treasury yesterday that comes due December 31st of this year to yield 4.94%, and you don't have to pay state taxes on that money anywhere in the union.
That's better than what you'll get with a CD.
And that's right. And the CD yields are way up there too. So that is, 3 times what you could get only 15 months ago, I would say. So there's huge opportunities right now. And, you sent me an email late yesterday talking about how the bond market is cheaper than the equities markets. And I happen to agree, but I think that is if your focus is on the short-term stuff that's yielding, in the 5s or thereabouts.
Yeah. I mean, the short-term bonds are more attractive to us. If you're buying long-dated bonds, you're taking a big risk, and that's only going to pay off for you if we go into a deep recession, which could happen.
There's no guarantee in that either. It's going to come down to we've already said, what got this decline that we had last year going was the markets being held hostage by. It started off as supply chain disruption, inflation that escalated into just full-blown inflation. And I think Jerome Powell's done a wonderful job, even though they started very late. But he seems committed to me.
Yeah,
and the numbers have come down to the 6.5% level. Now we're going to get some new information. We're going to get the new CPI and PPI numbers, both of them, back to back next week. So these are the most important numbers that the Fed is watching. Again, the market's being held hostage by the CPI and PPI prints, and then Jerome Powell's response to what he's going to do about it, right?
Yep.
What else?
Do you have any Tums?
I do over there,
Thank
right
you.
over there. I would like to point out one other thing that we mentioned yesterday that I think is an opportunity. And this is important for any of our viewers, this is a subject matter that's a little bit more complex. But last year, there was a niche area of the alternative space. And again, we define alternatives as, if you think of owning stocks, bonds, or cash, now think of anything that is not that, and we would call that an alternative. That's a very broad definition. But in this space, mutual funds that run algorithm run strategies in the commodity space, which is
Pork bellies.
four pretty much equal areas of global stock markets, global bond markets, global currencies, and then any commodity that you can think of, except I don't think pork bellies actually trade anymore, Bill. It's lean hogs are kind of thinly traded, but you can trade lean hogs, no longer Eddie Murphy's pork bellies in the movie Trading Places. But anyway, those things all made typically 15 to 25% last year in a market that got crushed, because they have a means to capture trends. And I think that we're going to continue to see some pronounced trends, and especially various places. If you think any kind of trouble or back and forth, you really don't want so much back and forth. You want 10% of the trades in these things make all the money, because these are trends that last way longer than anyone could have anticipated. And but here's the deal: is they futures contracts are levered, even though these funds, I would say they are low to moderate risk when you compare them to the stock market, and very diversified. But all they need is 10% of their capital to put all these trades on that present themselves in a rule-based fashion or strategy. And then 90% of the money goes back into fixed income securities, and they want to earn as much as they can on cash balances. So if you have a fund that has an expense ratio of, let's say, 1.25%, and they're getting 5% now on their fixed income investments, these funds have a tailwind of 3.75% that historically hasn't been there, for 10 years or so.
Yep.
And so if anybody out there hears this and has a question about managed futures or algorithm run strategies in the commodity space, Bill and I have spent a decade sifting through all this stuff to find the ones that of course we understand and like, and they do deserve a place, I think, in just about every portfolio. You agree?
Yes, I agree.
Yeah. Okay. Golly, you and Wesley must have had way too much to eat.
I'm telling
for
you,
lunch.
I'm just a zombie right now.
Well, what else do we have to share today? I thought you were going to come in here with, some kind of finance 101 or 201 or 301 or
0.5.
0.5. I guess, that's about it. I think that, now's a really good time to be, it's tax season again. And, everyone's going to be going to sit down with their accountants and go through all this stuff. But I think it's also a wonderful time to, check in with us. We do our annual performance reviews. It's a time to rebalancing. Let's say we have a portfolio that's 50% equities, alts, and 50% fixed income. And those numbers got a little bit out of whack last year. now's the time to rebalance, revisit goals and objectives, reevaluate how you're doing, with your goals and where you ultimately want to be. Rebalancing forces us to sell that which is high and buy that which is low. And so we're seeing even some of the things that got really whacked last year have come out of the chute and done very well now. If you think that inflation is going to remain stubborn and the Fed's going to have to hike, you're not going to want to be in NASDAQ or really growthy type names, especially those that sell at high multiples. It'd be a good time perhaps to shift some of that off the table, go back into higher income paying, low valuation type things. We've had a lot of success with that in the last 2 years. And if we can help anybody with anything at all, just give us a phone call, and thank you for listening, and go Eagles.